Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Welcome, welcome, welcome. It's Wednesday. It's a big, big day. Today is September 21st. We've got the Fed coming out in a couple hours with interest rate decisions, and I'm going to be talking all about it in today's video. If you guys are enjoying this video, gaining some value, have questions for me, post it below this video in the YouTube channel. I'll respond to your answer, and other people will be able to see it too. So please post your comment there. And if you have a question, send me an email, support@marketgeeks.com. I do want to hear from you. Now, let's get into it right now. Now, again, market's going to open up in about an hour and 25 minutes. We got plenty of time. The reports don't come out till after the market opens today, so we don't really have anything to hurry for right now. Or anything updating before the opening bell. There's no real major stimuli. As you can see here, the market's fairly flat. The Dow's up about 124 points. The Nasdaq is up 22 points. The S&P's up 15. This is really random data based on what we're seeing. Now, what I was doing yesterday is I was looking at volatility, and I want to show you something very interesting. And this is something that's been really that Wall Street has not been focusing on lately. And that's this. Let me show you. Average true range. So if you put this on, you will start seeing that even though the market went down all the way down to the base, almost to the base, and I think we're bottoming out here, look at volatility. Volatility went from 390 to 570, right? Look at the last time the market did this. Volatility went from 460 to 760. This time, from 390, so it was already lower to begin with, to 570, all right? So 757 points a day on the Dow versus 570 points on the Dow. And notice it's already cooling off. But the point is, typically when we go down, volatility really rises. It didn't rise that much. And also, it already started moving lower, which tells me that we're near the lows in the current level and that we're going to rally from here. And I believe this is the impact of the market assimilating the fact that interest rates are, in fact, going to go up 0.75, that they're not going to go down to 0.50, and based on what I'm seeing now, they're not going to go anywhere near 1 for the foreseeable future. The Fed is going to stay at 0.75. That's what the bond market is anticipating in its price. And it looks like the Dow is getting ready to rally. And again, the fact that volatility already started moving lower as we were going down, and the fact that it's not going up that much, is a very, very, very positive sign. Because one of the biggest factors that determines a bearish market when we go down is volatility. Volatility really, really increases, and it's not being as much it's not increasing nearly as much right now as it was increasing earlier in the year. For example, look at this downside right here. 700. Look at this downside right here. 700. How about right here? 700. How about right here? 500. So volatility is finally coming off on the market going down back to its base. That's very, 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 very bullish. Another very bullish sign. I'm going to give you all the bulls before we get to the bears. Consumer discretionary is not going into this channel. The Dow, the Nasdaq, look, QQQ, everything went into this channel. The QQQ, look at that, in there. But look at consumer discretionary. And that's a very, very speculative sector, right? Did not break the low, and now we're ready to go higher again. Very, very, very bullish sign. And another bullish sign, and I'll talk about this next couple of minutes, is volatility via the VIX did not go higher. Look, we didn't spike on this downside move. We spiked on every move down, but not this time. And I think this move is ready to go back down. And that's actually going to be the short trade. Remember, today's Wednesday. I give you a long trade and a short trade. And the trade to the downside is going to be buying puts on the VIX. And I'll talk about that in a little bit. Let's talk a little bit about global economy. And then we'll circle back into all of these nitty-gritty trade ideas. So, investors, they're looking ahead to a widely expected interest rate hike by U.S. Federal Reserve to try to tamp down the highest inflation in decades. And I think if we give it a little more patience, we will see it. It's just taking a little longer to get there. Global tensions are adding to uncertainties. Russia and Putin, baby Putin is at it again. Russian-controlled regions of eastern and southern Ukraine have announced plans to start voting this week to become part of Russia. That's not going to go down real well. Kremlin-backed efforts to swallow up 4 regions could set the stage for Moscow to escalate the war against Ukraine, which wouldn't be good for energy prices, basic materials, and all those things that I'm expecting to rally once again. Mr. Putin recently blasted what he describes as U.S. efforts to preserve its global domination and ordered officials to boost weapon production. Not good at all. Bonds edged higher. Yield on the 10-year, which influences mortgage rates, rose 3.56 from 3.52, highest level since 2009. And the 2-year is just going crazy. The 2-year has the most negative correlation to interest rates, to the bond market, excuse me. The yield on the 2-year, which tends to follow expectations of the Fed, held steady at 3.95, hovering to its highest level since 2007. Folks, we're pricing all of this stuff in. Mr. Fed Chair Jerome Powell, don't get me started, bluntly warned in his speech last month that the rate hikes would bring some pain. So I'm not gonna stop here. I'm gonna do it every chance I get. Remember, it's transitory. Remember, it'll go away. Now bring some pain. You had to wait till you got re-election to be honest, huh? I'm calling you on it, Mr. Powell. I know you may be watching these videos. The Fed is expected to raise its key short-term rate by 0.75 of a point. That would lift its benchmark rate, which would affect consumers, businesses, to about 3.325, the highest level in 14 years. We're still not that high. I mean, I think mortgages are about 5.5%, 6% now. Clues to whether the central bank remains primarily focused on lowering inflation or if there's a hint that the Fed is giving more consideration to the impact of higher rates on the economy. My opinion is they're going to go 0.75, they're going to go again 0.75, and then they're going to wait and see what happens. That's my opinion. And I think that's what's being priced into the bond market, just saying. Now, the U.S. is not alone. We're not suffering alone. Hot inflation is global. You've got Bank of Japan beginning a 2-day monetary policy meeting today. And rates from Norway, Switzerland, and Bank of England are up next. So everybody's raising rates. Now, if rates go up in foreign countries, that may take some edge off of the U.S. dollar, which has been inflated like there's no tomorrow because of inflation. Now, one thing, look at small caps. The ARK Fund, Kathy Woods, noticed consolidation. I want to show you guys something. Look at the Russell 2000. And this is something I was talking about during yesterday's webinar. We launched Code Breakers yesterday. Look at when the Russell started going flat. And the only reason the Russell rallied here, it was because there was a chance that Biden was getting elected and he was going to cool off the sanctions with China. And when we found out he wasn't going to be soft on China, it went right back down. So as far as I'm concerned, the Russell started a bear market March of 2021. The QQQ did not start a bear market till a year later, till 11/19/2021, and the S&P not till 1. Look, all the way January. So while the S&P was climbing, and I mean climbing, like at a 25-degree slant, the Russell 2000 was choppy. Small caps anticipate negative economy faster. They're more speculative. People offset these stocks much faster than your grandmother's blue chip stocks, right? It's common sense. And when things get good again, they start buying these stocks because they're more speculative. They've got things that are happening now. They're more fun, exciting. GameStop, the meme stocks, those are Russell 2000 stocks. So the point is, the Russell peaked out several months, like 7-8 months before the rest of the market. And the Russell is holding on right now better than the rest of the market. Matter of fact, when you look at momentum levels and you look at the Russell, 26% are trading above the 200-day moving average. 25% are trading above the 50-day moving average. Look at the NASDAQ 100, 16%, 17%, right? 25 versus 16, 26 versus 17. The point is, the Russell is starting to get stronger. Even S&P 500, look, 24%, right? 26%, 21%, 25%. The Russell 2000 is holding on. Those Kathy Wood stocks are holding on. That's a very, very strong sign. The fact that volatility is moving lower as the market is going higher. excuse me, the fact that volatility is moving lower even though the market's moving lower. Excuse me, I apologize. Very, very strong sign, as I'll show you right now. Look at this. Look at this. Even right here, when the market's going down, volatility is going lower. We're not going higher. We're going lower, not higher. So again, this is really, really, really important. This is very, very significant. Volatility. Look at this. We're going down. Volatility did not go up. It went down. So this is really, really, really important. And also, again, as I mentioned earlier, the fact that consumer discretionary stocks, where the old resistance is becoming a new support, this is very, very significant. So I think most of the downside is priced into the market. And I think most of what we've seen is already there. Bonds have not really declined all that much from last Tuesday's CPI. I mean, we went from 107 to 106, one handle. So I think the divergence, I think we're going to rally from here, and I think it's going to bring the market higher. Now, today's Wednesday. What do I always do Wednesday? I always give you my top stock and bottom stock. So just a few things. As a sector, folks, you should be looking at real estate. I've never seen momentum levels this low. No stock is trading above the 50-day moving average. 6% are trading above the 200-day moving average. You may want to load up on a little bit of real estate just to have, because it's really undervalued right now. And I think it's going to go up. Also, to the upside, I like Dollar General. My throat is so dry this morning. So I think we're going to cross back above the 50-day moving average. I think defensive stocks are going to rally once again. I like Dollar General to the upside. And to the downside, I think we're going to see a reduction in volatility. I think volatility levels are going to decline back to the 22, 23 level from the 26. So I would be buying a put. Matter of fact, that was our bonus trade yesterday. We put on this trade and we went to, I think, 26 or 27 strike price put. But I think volatility is already pricing in this rate hike. And I think it's going to be 0.75, and I think most of the sectors and the market is already assimilating it. And as I mentioned to you guys several weeks ago, when this looks like this, then we're going to be done. And right now, the 50-day moving average, looks a lot like the 200-day moving average, maybe a little lower, and that means it's time to start a rally. So I'm really liking small caps right now because, A, they're outperforming the market. They're not correlated with the market. They tend to rise, go into the sunset faster and rise faster because they're speculative. Speculative stocks are sold off first and they're bought first. The fact that volatility is no longer increasing or spiking as much is a very, very bullish sign. Now, in light of that, I've got something to tell you that's interesting. Volatility might scare investors, but it's great for traders. And there's a subset of the stocks that tend to move 3 to 7 times more than the average S&P 500 stocks. It might be my favorite group of stocks to trade right now, especially when a certain candlestick pattern appears. And this candlestick, folks, has a ridiculously high track record, okay? Click the link below to see what I mean. I'm calling these stocks code breakers, and you'll see exactly why when you see the research that I put together. Folks, click the link below. Get the details now. You will not regret it. I want to show you something. And let's see if my stock fetcher works now. Nope, still no. But I want to show you something interesting. Look at these top stocks. Look at these top stocks. 189%, 244%, 210%. These stocks. Not S&P stocks. High alpha stocks. Stocks that are just going crazy and are constantly in a bull market. So we applied my most high probability strategy to these top alpha stocks that just move like crazy. It's a match made in heaven. Follow the link below. Learn about code breakers. We had our launch yesterday. It went amazingly well. I mean, we just killed it yesterday. Follow the link below. You need to check it out now. You're going to learn a lot of information. It's very valuable. It's no Ferraris or golf courses or mansions. It's meat and potatoes. Follow the link below. If you're enjoying these videos, if you have questions, post comments in the YouTube channel under the video. I will respond to you personally today. Bye, guys. Have a great, great day. And I appreciate all those great emails that you've been sending me to support@marketgeeks.com. Have a great, great day ahead. Bye.